Bond funds are not replacements for individual bonds because they act nothing like an individual bond. Bond funds are made up of hundreds or even thousands of individual bonds, and some of them come due or mature every day, and they have to go and invest those proceeds into new bonds. If interest rates are going down, then the bond fund is continuously buying new bonds at those lower interest rates. They may have one bond at 5%, another bond at 2%, another bond at 3%. Instead, you would have locked in 5% over the life of the bond in an individual bond. The fund is also continuously buying and selling new bonds for the fund. If money is going into the fund, then the fund has to buy more bonds. Conversely, if money is flowing out, it has to sell bonds. And that may not be at the best possible time for buying or selling those particular bonds. Even worse, investors are irrational. They'll be putting money in at the worst possible time to be buying new bonds, and they'll be pulling money out at the worst possible time. It would be to sell those bonds. The fund manager is then at the whim of the irrational investor. And finally, as an individual bond gets closer to maturity, it gets less risky. We'll be covering that in our next Market Minute called Pull to Par.